When I was looking at what to talk about, I had a number of options, and my staff said that the one where I talk about the difference between the Trump Act and the Biden proposed tax act would be the one that they have had the most questions on. So, give you a little background. So, in 2017, Congress passed his signature tax bill, which went into effect for the 2018 tax year, and it actually expires at the end of next year. So one of the main provisions of that tax act was taking the corporate income tax rate from 35% down to 21%. The theory was that corporations didn't have to pay as much in taxes, and they would therefore pass that money on to individuals, which of course didn't happen. So all of those provisions that have not been made permanent are due to expire at the end of next year. Congress has proposed that some of them be made permanent. It just takes Congress voting on it this year or next year for that to happen. But if it doesn't happen, the main things that are going to expire are that affect individuals. So the 21% corporate tax has been made permanent. What we have today is we have a higher standard deduction, but no personal exemption. And most people don't itemize today because the standard deduction is high enough that it exceeds what's allowed for itemizing deductions. And the reason for that is that you're only allowed to write off $10,000 of taxes on your itemized deductions. So income tax, property tax, sales tax. If a person was able to write off all of their taxes, then the standard deduction would not be higher. But it's called the SALT limitation, and that is due to expire. The higher standard deductions are also scheduled to expire. Capital gains prior to the TCJA Act were 15% long-term capital gains. The act imposed a zero tax for low-income people on capital gains, then a 15% tax up to about $350,000, and then a 20% tax. It, at the same time, decreased the effects of AMT on wealthy people. It just almost totally eliminated AMT for the tax itself. So those adjustments are due to expire. The capital gains rates are due to expire. The tax rates that are currently out there are also due to expire. The highest federal tax rate today is 35%. The highest federal tax rate, if the tax rates are allowed to expire, will be 39.6%. And that's on very high incomes. And then the child tax credit is due to expire. Right now, today, it's $2,000 for an older child and $2,500 for a younger child. So the bottom line is that the 2017 Tax Act increased the national debt. It never paid for itself. It was supposed to have paid for itself every year. It absolutely did not, because people did not have the money in hand. And part of the reason, of course, it didn't, and can't really blame everything on the Tax Act. COVID had a huge impact on it, but it did add to, in the 18 and 19 years, it added to inflation, and it primarily benefited people that had incomes greater than $400,000 and corporations, and therefore owners of corporations as well as CEOs. Now, the Trump proposal, he has put out very little in the way of actual plan. He's indicated some things. There's a portion of the Republican caucus in Congress that has proposed some very interesting tax proposals, none of which do I think will ever pass. It's primarily the wingnuts that are proposing it, not the reasonable Republicans in Congress. So, but these are the things that Trump has put out there that he has mentioned that he would do or wouldn't do if he were elected. So to start with, He would not allow the 2017 tax proposals to expire. And if they were increasing our national debt before, they will go right on increasing our national debt. There is a tax out there that's called the net investment income tax, and it's on income over 400,000 on a joint return. It's a 3.8% tax on income over that level. And what that does is it goes to pay for the ACA, the Affordable Care Act. It goes to pay for Medicare. And you say 3.8 is kind of a random number, but if you have Medicare, if you have payroll, if you're a wage earner and you have money withheld for Medicare, it's 1.9%, and your employer matches that 1.9%, hence the 3.8%. He has suggested that they remove that. He has also wants to repeal the ACA because, of course, he's still trying to fight with Obama over the need for medical insurance. He can't seem to let that one go. He wants to decrease the payroll taxes. Now, the payroll taxes are Social Security and Medicare. So if he decreases the payroll taxes, that decreases the funding for Medicare and funding for Social Security, primarily the senior citizens that are already on Social Security, and the disabled and widows and children of deceased people, the minor children. He wants to put in a 15% retirement savings that would be mandatory of all earned income without an employer match. So you can see how that kind of benefits the higher income employer. This savings account would be allowed to would have growth, and you could remove the growth from it tax-free, which means people being people would remove that growth probably annually and have no savings for their retirement, and limiting the amount of money that's going into Social Security, no real growth in Social Security. He will allow all capital expenditures. Today, if a business buys equipment, they're able to write off a direct write-off of, I think it's $50,000. There's some other caveats, and then they can do a Section 179 on another collection of money. But the rest of the cost of equipment, which is primarily big industry, they can't write off. They have to amortize and depreciate over a number of years, 5 years and 7 years primarily, but some things are 15 years. So his proposal is that all capital expenditures for all businesses are a direct write-off in the year purchased. That would decrease taxable income drastically for big corporations. He has said that he would propose a blanket tariff of 10% or a matching tariff for what so if Germany charges us a 10% or a 12% tariff, we would charge them a 12% tariff. Wouldn't matter what the goods were. It would just be an automatic matching tariff for any country. So once again, this is something that really hurts small businesses. It hurts individuals, because if you go someplace like TJ Maxx or Ross, and the majority of their clothing is made in China, and now we're going to impose a tariff on those clothes, and who's going to pay that tariff? It certainly isn't going to be the incredibly wealthy, because they don't care. It's going to be the person who really cannot afford to pay that, particularly after having a mandatory 15% savings put away. So once again, this is definitely not hurting the affluent. There would be an additional tax cuts. So if you say you're reducing the reducing the net investment income tax on people making over $400,000. That's a huge benefit if somebody's making $1 million or 2 million times 3.8%. And it's a huge benefit for employers that don't have to pay in as much in a matching payroll system. He would repeal the inflation adjustment on corporate income tax so that it would never change off of the 21% it is today. And what his ultimate goal is to move to a national sales tax. Now, an income tax is, it's a tax. You have your gross income, and then you get a write-off, some itemized deductions, you get some personal exemptions, usually on the state level right now, it's, standard deduction. On the federal level, unless you have really high interest and charitable giving, that's about the only time I see itemized deductions being used anymore. But then what you have left is what you have left, right? So you're going to take and save part of that maybe, and you're going to spend part of it. But if you have a sales tax, so with an income tax, there's a buffer of which you don't pay tax on. That's the self-employment tax. I'm sorry, the standard deduction, itemized deductions, personal exemptions, any other kinds of write-offs, capital gains. You only pay a smaller tax rate, sometimes no tax. If your income's low enough, you don't pay any tax on your Social Security. So there's always a buffer in there in an income tax situation. But if you have a sales tax, then, and you are lower income, you are primarily going to spend every dollar you get. So you're going to pay tax on every dollar you get. And there is no buffer. If you're middle income, maybe you're able to save a little bit, but you're still primarily going to pay tax on every dollar you get. You're not going to be saving 10 or 15 or 20 or 50% of your income. You may save 10%, but that's going to be about it. The wealthy, however, are only going to spend a very small portion of their income. And so they only pay tax on a very small portion of their total income. And so it's considered a regressive tax. And that's what he wants to move to, is a national sales tax. So, I mean, it's one of the reasons that wealthier people are moving to Washington, because they don't spend all their money, they save part of it. And if they're in Oregon, particularly if they're in the Tri-Counties and the city of Portland, they're going to pay income tax to the county. They're going to pay tax. They're going to pay the housing tax. They're going to pay the child care tax. They're going to pay the state income tax. They're going to pay the federal income tax. They could move to Clark County and they're going to pay a federal tax and sales tax, but only on what they spend. So it is a huge difference and a very regressive tax. So those are the things that he's put out there that he wants to do. Now, I'm sure there are other things that he has not put out there, but we don't know what those are at this point. On the other hand, President Biden listed in his State of the Union address the things that he wants to do. And he's added a few things to it since the State of the Union address, but not a lot. So one of the things he wants to do is he wants to change that corporate income tax from 21% to 28%, because he doesn't think that they're returning any of that tax savings to the workers or to the economy. The tax was 36%. He thinks 28% is a fair compromise, and that because the trickle-down effect didn't work, that it's probably a better amount that the corporations need to pay their fair share. He wants to put in a 4% tax. Right now it's a 1% tax. He wants to make it a 4% tax that corporations will have to pay when they buy back their own stock. When a corporation buys back its own stock, they do it for a number of reasons. One is to increase the price of the stock. If you have, 10,000 shares out there at $2 a share and you buy back half, you now have 5,000 shares at $4 a share. And so the CEOs, the insiders, have a more valuable stock because theirs wasn't one of the shares that was bought back. So they do this in a way to increase the pool of stock that they have available to give to the CEOs as part of their compensation. And so, and this is one of the things that has really been a major source of irritation, is that CEOs get, 5 million, 10 million, 50 million compensation, but it's all in stock. So until they sell that stock, they have no gain. They have no taxable gain. They simply have stock. So what he's saying is that if the company wants to buy back shares so that they have this stock available to then compensate the CEOs at these exorbitant amounts, well, that's fine. But then the company's going to pay a 4% tax when they do that, so that there's money going into the economy to help other people. He wants to keep the SALT reduction for the write-off of, I'm not sorry, not the SALT. So right now, corporations, businesses in general, but corporations are primarily where it's at, can only write off interest under certain rules. They can't just run up a huge debt and write off all the interest on that debt and not pay tax. They have to have some definite rules around it, and it's taken away a lot of the ability of companies to make huge write-offs for interest that they spend, and maybe they spend it in ways that it actually comes back to the company. As we all know, there's some definite games that companies play, have pointed out to us more recently with all the things that have gone on. So he wants to keep that limitation on the amount of interest that companies can write off, and therefore paying higher taxes. He wants to cap the amount that a company can deduct for any individual employee's wages at $1 million. So if they pay the CEO $10 million, they can only write off $1 million on the corporate return, and the other $9 million, even though the CEO picks it up as income, cannot be written off on the corporation, and thereby paying more corporate taxes. You kind of get the gist of it. The more the companies pay in taxes, then when he's giving, as we'll see in this next section, as he's increasing benefits to individuals, this is part of how he's planning to pay for it, is with all these increases in the corporate income tax. So retaining parts of the 2017 Tax Act, probably he'll retain that SALT limitation, the tax limitation, may retain also the higher standard deduction that seems to work well for people. Itemized deductions typically they were just a headache for people. They had to go back and dig up records and try and figure out where they were. So as I say, the only people that really do itemized today are people that write off the 10,000 of taxes, have really high interest write-offs, and give really big charitable contributions. If those people still do the itemizing, everybody else takes the standard deduction. It's easier. You don't have to keep track of everything. And so that probably will be made permanent into the tax law before the end of 2025. So as I said earlier, with the 2017 Act, it changed the way the alternative minimum tax was calculated. So, and the alternative minimum tax has been in the law since about, I think it came in with the 1986 Tax Act, and it was put in as a way to make it so high income people had to pay a tax. So what was happening back in pre-86 was you would buy into a partnership. You would put $1,000 down. You would sign a note for $10,000. You would then turn around and get a write-off the next year for $10,000. And the intent of paying back the $9,000 never was there. You never, ever paid that back. And so high-income people would get this huge write-off after having invested only $1,000. So the alternative minimum tax said, well, if high-income people are getting a tax preference, then we're going to add that back, and we're going to create an alternative tax system. And with the alternative tax system, the alt-min tax, you either paid a flat 21% or a flat 28%, depending upon your income level. And so even if you only paid 15% on ordinary income because you had been able to have these huge write-offs, when you had to add all those preferential items back that the ordinary person would never be able to afford, now you had to pay a 21 or 28% tax, and you always had to pay the higher of the two. So with the 2017 Act, it made the amount that your income had to be after adding back the preferences so high that I think I've only had one person that had to pay alt-min in the ensuing years. And it used to be, it was pretty prevalent. So one of the things that President Biden wants to do is remove those changes and lower that income level again, so that if a high income person is able to write off a great deal because they can take some big losses flowing through from passive activities or from active activities, then they'll still have to pay tax. And so he wants to take that piece out. Now, with the net investment income tax, as we talked about earlier, Trump wants to remove the net investment income tax altogether. President Biden wants to take the amount that a person on a single return at 400,000, the amount of income on a joint return over 450,000, and change that from a 3.8% tax to a 5% tax to help further fund Medicare, Medicaid, and the Affordable Care Act, so that more people can afford to have health insurance in a way to make it so that even though we don't have a national health policy, it makes it so that more people in the lower income brackets can afford better health care. He wants to keep the child tax credit, which I said earlier was $2,500 for young children, $2,000 for older children, but he wants to increase it to $3,600 for young children and $3,000 for older children. And he wants to make any unused credit 100% refundable. So if you are low income and you've got 2 little kids and you don't really have a tax, then you would be able to get a $7,200 refund, even though you hadn't paid anything into the system. Also, we have had in the law for years and years and years, that I think it was there when I started doing taxes, and I started doing taxes in 79. So is a provision of the law that's called earned income credit. So originally, if you were a low income person, but you have to have earned income for this to work. You were a low income person, you had earned income, investment income doesn't count, spousal support doesn't count, none of the other kinds of income. And you had a child that you were supporting, and that child lived with you the majority of the time, and they were your dependent, then you got a credit that basically, and it was a refundable credit, and it could be a fairly substantial amount that you would get back because you were being incented to work and take care of your child. Well, then they kind of opened it up and they said, well, you could have it with any dependent. So if somebody was supporting their parents, that would work. Or if somebody was supporting a sister or a brother or somebody that wasn't able to earn money, that would work. Well, what President Biden wants to do is open it up and say, if you are working and you are such low income, you don't have to be supporting anybody but you. And we think that you should have a refundable credit that will help go to pay for you. And so that's one of the things he wants to do. He wants to put the top tax rate back at 39.6% and really go back to the pre 2017 tax structure for income over $400,000. Income under $400,000, leaving it in the same brackets and with the same rates. Our lowest rate today is 10%. The lowest rate in 2017 was 12%. So you can see there's definitely an adjustment. And then some of the more interesting things that he wants to do is if somebody has capital gains and they have greater than $1 million of income, that they're going to have to pay ordinary income tax, 39.6% at that level on their capital gains instead of 20%. So you can see that would have a huge impact, and for high income people, not overly a popular one. Today, if somebody dies, they get a step up in basis on their assets. So if somebody has, say, $5 million in the stock market, maybe they paid $1 million for it, but it's been in the market for a while and it's worth $5 million. They die, their heirs inherit that money at $5 million. They turn around and sell it the next day. They have no income tax. So what President Biden has said is, you have $5 million of gains that you, when you die, that they're not taxable because nothing's been sold. Anything over that $5 million limit, you're going to have to pay capital gains tax. So if you have $6 billion, then your heirs are going to have to pick up, or your estate, the capital gains tax, 20% on $1 million. And you get the 5 million with a step up in basis. The other million, you'll get a step up in basis, but you're going to pay a 20% tax to get that. So this is quite a shift. And there's a couple of things that we'll talk about that he's done that are quite a shift, where you don't have to sell an asset to pick up the tax. So if you are really high income and you are worth more than $100 million, then on an annual basis, you will have to fill out an income statement stating what your net worth is. And if your net worth is over $100 million, then you are going to be required to pay long-term capital gains tax on your assets, even though you have not sold them. So every year, you can just picture the nightmare that this would create, right? Every year you have to fill out an income statement, calculate your net worth. If it's over $100 million, then the accountant looks at all of your assets, looks at what they were worth at the end of the year, and calculates the gain, unrealized gain. You pay a tax on that unrealized gain, and then next year you look at those assets. Some of them will be the same price, some will be different, but calculating what you've already paid, now you don't have to pay twice, and calculating what it was worth a year ago and what your new gain was. So it's, I think that part of the law, I think he's thinking of benefiting accountants and tax preparers, because that definitely would drive up a tax return cost by about 5 times. Now, today, if somebody dies, a person, each person, they get to exclude $12,920,000 before they would pay any estate tax. Now, this was part of that 2017 Tax Act. Prior to that, the amount was $5 million. So it's proposed that that number would go back to 5 million in 2026. So we've had this in the law a few times, but truly, it's one of those, grandma's really old and she's been on life support for a while. Do you pull the plug before midnight, assuming she'll die quickly, because she's worth $10 million and it's all tax-free if she dies in 2025, and half of it's taxable at 54% if she dies in 2026. So that creates some conundrums in itself, and always interesting when they put in these provisions in the tax law, and you always wonder how many people get the plug pulled about Christmas Day just in case they don't immediately die. Now, Biden has said that he's got some pretty hefty tariffs that he put in on China about 3 months ago, as did many countries on their China's technology. We've put in a huge tariff on their cars because, heaven forbid that GM and Ford should have to compete with a Chinese-made car that is probably at this point designed better, gets better electric miles, and is maybe even more comfortable. But we don't want to, have Ford and GM have to compete and get their act together. So we put in a big tariff and said they can't import just a moment. I'll put it on my couch. Dakota, honey. You're fine to start. No, come on. You're gonna go into your crate. Come on, quiet, finish my. No, you're not going to crate. Come on, babe. Yeah, I'm doing perfect. What a good girl you are. Yeah. Come on, in there. Sorry about that. She's not used to seeing the tractor out back. He is the guard dog. So, anyway, so the problem with tariffs is that if we say, okay, we're just gonna charge you a flat 10% on every single country, on every single good. Once again, that doesn't necessarily affect the wealthy because they're wealthy. They have disposable income. But if somebody is in a middle income bracket or a low income bracket and they now have to pay a 10% increase on everything they buy, that's pretty harsh. So Biden says that he'll only tariff countries as needed, i.e. to, protect the American car companies and the jobs that those create, but also technology is an area that gets tariffed. But something like Gucci handbags, I think Gucci makes handbags, those would not be necessarily tariffed because we are not a big producer of leather handbags. So we don't, there's really no reason to tariff something that we don't have any need to protect the competition on. So, but it would be a country by country, industry by industry, not just a blanket. If you're out there, we don't want your product, so therefore we're just going to charge you to sell it here. He also wants to limit if somebody has a huge, if you're a wealthy person and you're working, you're going to put away the maximum into your 401k every year. You're probably also, if available, going to put the maximum into a 457. You may put the maximum away in deferred compensation. So you could easily have $4, $5, $6, $7 million in retirement dollars that somebody that doesn't have that kind of disposable income would not ever have. So, and then that money, sits there and it grows tax deferred. You retire. You can leave it to your heirs. Now they did change the the way that a person has to withdraw that money, but you know, if you have a husband and wife and the husband dies at a relatively young age, the wife gets that money. She could live, you know, say to be 100, so that's a long deferral period. And then she can pass it on to her beneficiaries who now have to take it out over the next 10 years. So you have effectively sheltered that money maybe from age 70 to her dying at 100. So 30 years, and then the kids have to take it out over 10 years. So effectively deferring the tax on that money for 40 years. So Biden has said that what he would like to see, if you have a really large retirement, you're going to be limited in what you can put in. And he hasn't really specified what large is, and he hasn't specified what limit is. But I would suspect that large being somewhere around $1 million and limit being somewhere maybe half to 2/3 of what somebody else could put in, or maybe no over 50 increase or something of that nature, to keep the money not only from being put away for a large number of years, but to keep that money fluid and in the economy, and hopefully being taxed on an annual basis. So then, let me see. So the other place where there's a big shift is if somebody does a 1031 exchange. Now, 1031 exchanges are only allowed on real estate these days. Used to be you could do, you know, just about anything. You could do, at one point you could do a bull for a bull, but then they lightened that up and you could do any kind of livestock for any kind of livestock, or business for a business. But a couple of years ago, they went back and they said, no, you can only do a 1031 exchange on real property. But, you know, if you have a building that, you know, you paid $1 million for and you've owned it for 20 years and it's now worth 20 or 30 million, and you exchange it for another property, you could defer, and for of that same cost, you could defer all of that gain for years and years and years. And then you get to, well, let's go back to a lesser, but say you had a property that you paid 500,000 for, and you sell it for 3 million, you know, $2.5 million gain, but you buy a building that's 3 million, so you've deferred that gain, and maybe you do that again and you defer maybe another million, and then you die. Well, now that your last building gets a step up in basis, and that deferral never gets taxed. So what he said is that he wants to put in a maximum amount that you can defer of $500,000, which, if you're talking real property, that's not a huge amount, and easily something that's going to be topped over. And this is not personal residences. This is business property. So apartment buildings, high rises, office buildings, medical buildings, anything that is a business property, income producing property. So he wants to put that in once again, because it's typically people who have more money that would be in that position where they would end up with over $500,000 of gain. And then the other one, which I thought was the last thing, is that all of these giveaways, you know, we're talking a lot of money going out the door. We're talking a lot of benefits for low income people. And we are talking a lot of money coming in from the wealthy. And the net effect of that, if it were all to flow as projected, which of course is always a big if, is that over the course of the next 10 years, there would be this tax act would pay down $2 trillion of the $34 trillion of national debt, and the national debt would not increase in that period of time from excess spending. So not a bad position. There are some things in there that people, I mean, there are many people in my client base that their tax return has more than $400,000 on it, and they're gonna get hit by this. But is it worth it? And you kind of have to ask yourself, is it worth it to pay extra in tax if you're a wealthier person, and to start paying down our national debt so that our kids, grandkids, great-grandkids don't have that hanging over their head in the years to come? So with that, I will look at questions. How much did that hurt what? Nonprofits.
Sorry, Diana, we lost the context. It was way back. It's Suzanne. I was just curious about the change in itemized deductions, disincentivizing charitable contributions. Has there been any studies done on the impact that that's had on the nonprofit sector? Because the only folks that are giving are the folks giving at the high level, and proportionately folks that make less proportionately give more to charities.
Yeah, they do.
And so that also impacts those services that you're talking about that are going to be impacted by those Trump proposals, because the shadow state is big. A lot of those dollars flow through nonprofits, and they're having a really hard time making it.
I know, and I have not seen a study, but I will tell you that when I look at the tax work, it definitely has reduced the amount of charitable giving. But you're absolutely right. The least wealthy in my tax base give percentage-wise the absolute most money to charity.
Yeah, it's inversely proportionate for sure.
And I'll tell you who really gives the most is the 80, 90-year-old people who stay at home and they watch those. If you just give $10 to feed this child, if you just give $10 to feed this dog, they give to every one of those charities. And I sometimes just want to scream, because I think that of their $10, probably $9.50 goes to management.
Yeah, that's really untraceable for sure. So the other question is around the childcare tax credit. I mean, millions and millions of children were lifted out of poverty. Like the last number I saw was something like 16 million. It's the most
huge.
effective. Yeah, it's huge. The amount of it's the most effective social policy we've had in reducing child poverty, which reduces big costs later in our systems that are very expensive. And so, do you think there's any likelihood that it can be rescued? Because every time I hear it brought up, it sounds like it's dead, and not resurrectable.
So I think that this is, Biden's attempt by increasing the child tax credit from 2,500 to 3,600 and making it 100% refundable. Where before it was not. If you didn't have a tax, there was only a small portion of it that was refundable. So if you have somebody that's in poverty and they just file a tax return and they have 3 kids that are under the age of 6, which does happen, they would get $3,600 times 3 in their pocket, which would be about half of what the child amount was. With I think that we'll see I think that Biden will fight to put that back in, because that was a huge part of his presidency. Whether Congress will agree to it or not, I don't know, but it certainly is not currently in his budget, because he does want to return that $2 trillion on the national debt, which will, in a different way, benefit those children.
Thanks.
Other questions, guys? You can either type it in the box or just unmute yourself and talk.
Diana, I keep hearing about de-dollarization. What's happening to that? With BRICS coming up with their own currency?
Run that by me again, Suda. My dog is barking.
I keep hearing about BRICS making their own currency, and the dollar will be not international currency anymore?
So, ever since Brexit, right? When London lost its grip on the monetary market in Europe, there has been a struggle going on between Germany and France, where they would like to have their dollar be the universal dollar in Europe. It's really helped to strengthen the euro and eliminate the pound. But the US's dollar is probably not going to go away as the preferred currency because so many countries tie their dollar to our dollar. I don't think that it's something that would go away in the short term being, 20, 30 years. However, we have some definite issues in the world, and unless we can come out of the next 2 or 3 years stronger than we're going in, we may lose that power. We may lose it to China. Now, the problem with China and why the yen is probably not going to be the current the yuan, the strongest dollar, is because we manipulate our dollar, and Europe manipulates every one of their dollars, and the euro gets manipulated, but not to the same extent that the Chinese government manipulates their dollar. And because they manipulate it so much, there isn't another country that wants to tie to it, because they could be a wealthy country with a valuable currency one day and have nothing the next. So I don't think that is a real concern, even though China is a huge economic power, as they just they manipulate too much, and they make their products they subsidize their production too much to really have the rest of the world want to compete in that same way. Does that answer the question?
Yeah, thank you.
Other questions?
Yeah, hey Diana. So the capital gains tax, there's been a lot of back and forth about that will kill the 401ks because majority of the market is 401ks. So if you jack up the capital gains tax, and they're talking like here in California, 59 to 60%, you got Gabenomics in there. Is this all just hearsay, or are we looking at our returns just going in the toilet? And I'm just being honest with you. Sorry, I don't mean to paint it as negative, but yeah.
So Marty, if they increase the capital gains tax, so keep in mind, I've been doing taxes for 45 years. And in that period of time, there was no capital gains tax. There was all gains were taxed as ordinary income. There was a couple of years where all gains were taxed at zero. There was some years when you had a 30% capital gains tax, but the ordinary income tax was 45%. So in those years, it has bounced around like you can't believe. And they have never taken capital gains out of the law, even in the year when there was no capital gains tax. They did not take that code section out because they knew they were going to bring it back in. But today, if they had a 20 or 30% capital gains, 30 or 40% capital gains rate, so that it was basically ordinary income, what that would do is it would severely benefit 401ks, not to detract from them. Because keep in mind that you put money into that 401k, and yes, you get the write-off at your current tax rate, but when you take that money out, you pay tax at ordinary income rates. And so the benefit of not putting money into a 401k is so that when you take that, if you don't put the money in and you just invest it, when you sell, you're going to get a beneficial tax rate instead of the ordinary income rate you would get if you took money out of a 401k. So if they made the capital gains rate high, then more people are just going to use the 401ks, the retirement plans. Because you're going to take away the reason for not putting money in the retirement plan.
Okay. I got to think on that one. You're awesome. Thank you. Yeah, I
Okay.
got confused on that in a little bit, but yeah. Okay. All right. No, thank you for explaining it that way. And by the
So
way,
anybody, yeah.
so
go
by
ahead.
the way, your glasses look great.
Oh, thank you.
I just want to say that yeah, sorry. I was like, ooh, Diana got new glasses. Okay. So, but why are they all saying, and you hear both sides nowadays, that is going to hurt the investors because now they got to pay more on that capital gain and they may not want to invest in the market. Once again, here's both. I know.
So keep in mind, so if you're mom and pop, right, and you put money into a brokerage account, an investment account, and you maybe every couple of years you buy or sell, and you have a high capital gains, that would be a deterrent in the market, because you could put the money into a CD, you could put it into a federal bond and only pay federal tax on it, not state tax. You could put it into a municipal bond in your state and pay no tax. So high capital gains where mom and pop investments are concerned, yeah, that would hurt the market. But if you're some CEO that's got $10 million in the market, you're just not going to sell, right? And that's why they're putting in the tax. If you have so much money that you don't need to ever sell it, then that's why the proposal is that you would have to pay tax on the unrealized gains.
Okay. Okay.
Instead of just on the realized gains.
Gotcha. I got you on that one. Totally agree with you. Okay. Well, thanks for the explanation. I appreciate it.
Oh, you're welcome. Thank you for the question. Okay, guys, any other questions? No? Okay, well, I did record this tonight, and my notes will be available on well, then I take that back. The notes won't be available, but you can listen to the recording. If you want clarification on something on the recording, just shoot me an email and I will clarify it. So with that,
Diana, is it too late to ask the question now?
oh no, go right ahead.
Oh, yes. I have a question about the Roth conversion.
Yes.
Because there's a way like information floating around about the tax after retirement for the high net worth people will be more or will be increasing, especially when what they call the sunset tax sunset or something. I forgot what's the term after the 2025. So my question is it some kind of formula where is it a Roth conversion always a good idea to convert, even though it's above that put the income above the tax bracket, like the higher tax bracket currently? Or if the Roth, if the IRA amount compared to, the ratio in comparing to the Roth account, it would be a benefit or advantage or disadvantage to convert.
So that's one of those things that's definitely person by person. So you have to look at a number of things. So if you convert, what's it going to do? If you are if you're a married couple and you're at, I think the number is about 84,000, and maybe your income at that point is only 50,000, and you have some capital gains, you would have basically no tax on that capital gains because you're below that limit, you're in that zero bracket. But if you do a Roth conversion, you're going to not only trigger the tax on the Roth conversion, but you might be triggering the tax on the capital gains. You certainly would be, if you're retired, triggering a higher tax on your Social Security. So, and the other issue is, are you going to bump up against the IRMA limit where you're going to pay higher Medicare costs for the, premiums for the next couple of years if you do a Roth conversion? So Roth conversions are a really great idea. You retire, you have enough disposable cash or stocks that are not in a retirement account that you can live on for a couple of years so that your income is basically zero, and you do large Roth conversions and then you don't do them again. So that's one scenario. Another scenario is maybe you have Social Security, you've got a little pension, you've got a required minimum distribution, but maybe you've got $10,000 delta between where your income is and the next tax bracket, and certainly you don't want to bump into that next IRMA situation where you pay higher Medicare costs. So maybe you've got a delta in there, and just converting that amount each year, just kind of looking at it at year end, you get to the first part of December, you can make a pretty good guess of what your income's going to be, and then do a conversion and do it year after year after year after year so that you're never really pushing ahead. So because a Roth conversion where you bump into the 35% tax bracket today, and you trigger tax on capital gains that you might not have had otherwise, and you trigger maybe a net investment income tax of 3.8%, and you trigger a higher Medicare cost, that's probably not worth it. So we sit down to do a Roth conversion, we look at all those things before we do the conversion, because once you've done the conversion, you can't give it back. You used to be able to. When they first came up with Roth conversions, you could give it back and say, yeah, just kidding. But they took that out of the law. So
I see. So, in that case, is it the like a CPA is the one who can give a right suggestion based on what is the amount to convert each year in order to like a factor in everything, or it just like we have to go consult with the financial advisor like yourself in order to know the whole thing, that because everything is related, since myself and my husband is both 65 already, and we haven't taken advantage of the Roth conversion. And
in our office, we have CPAs in the office and enrolled agents where we look at the tax picture. We have software that the financial advisors have access to, where they can do that computation for you. And and so Rachel and Christine and myself all are able to pull up that software and input it and input the data and take a look at where you are. Well, you're not going to be 100% because if you have a capital gain, if you have a mutual fund, can kick out capital gains at year end, it might screw it up. But for the most part, you're going to have a pretty good idea come the 1st of December of where you're sitting and how that's going to play out, and if it's worth it to do a Roth conversion and what dollar amount is going to be necessary.
I see. Okay. Are you still doing the tax for client, or you only do the as a financial advisor only?
So I am getting ready. A year from now, I will be retired. My last day will be May 31 of next year. But I am going to do taxes for the next 3 years. Sarah and I are doing taxes, and I don't see clients as a financial advisor at this point, but I am doing the money management. And certainly if Rachel or Christine want Sarah or I to step into a meeting and do the tax portion, we're there to do it any day of the week. I mean, we're more than happy to do that. Rachel and Christine just say, hey, we need you in here, and either Sarah or I will step in and do the tax calculation and explain that to the client.
I see. Okay. Thank you.
You're welcome. Anybody else? So yeah, we do taxes in the office. We primarily only do taxes for our finance clients so that we have lots of ability to support the finance side. We think we've hired another financial advisor that will be coming on board in July. Really nice guy. When we hired Joe, it kind of broke the glass ceiling, for men coming into the office. So we're going to have another guy in the office. Normally the glass ceiling is considered women getting to join a firm, but in our case, it's men. So, but anyway, we are looking forward to having another advisor in the office. He is incredibly knowledgeable, great guy. We expect that he'll sign all the contracts this week, and we'll start about the 8th of July. So if you'll get a letter regarding him as soon as he's on board, and then I would invite any or all of you to stop by and get to know him if that works out. Sarah also came on board to do taxes this year. She joined the firm last December, which is amazing. She's done a phenomenal job with the taxes this year. So feel free to stop by and visit with her, or if you have tax questions and you call Sarah or myself, and we can walk you through any of those situations. So with that, if there's no more questions, and if there are, speak up, but if there are no more questions, then we'll end it. We done?
Yep. I think so, Diana. Thank you.